Today, watch out, rate hikes are coming. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and problem news with a distinctively Australian flavour. Well, today the Reserve Bank of New Zealand signalled a change in trajectory of their monetary policy, which will have profound impacts on the future direction of interest rates. In a statement, they said that the Monetary Policy Committee agreed to reduce the current stimulatory level of monetary settings in order to meet its consumer price and employment objectives over the medium term. Specifically, the Reserve Bank will halt additional asset purchases under the Large-Scale Asset Purchase, the LSAP program, by the 23rd of July 2021. The committee will keep the official cash rate at 0.25% and the funding for lending program unchanged. The reason? The global economic outlook continues to improve, they say, providing ongoing price support for New Zealand's export commodities. Global monetary and fiscal settings remain at accommodative levels, supporting the recovery in economic activity. And rising vaccination rates across many countries are providing further economic impetus. However, the need to reinstate COVID-19 containment measures in some regions highlights the ongoing global health and economic risks posed by the virus. Recent data indicates the New Zealand economy remains robust despite the ongoing impact from international border restrictions. Aggregate economic activity is above its pre-COVID-19 level. Household spending and construction activity are at high levels and continue to grow. And business investment is now responding to capacity pressures and labour shortages, and measures of economic confidence continue to improve. The committee reiterated that there will be a near-term spike in headline CPI inflation in the June and September quarters, but they say these reflect factors that are either one-off in nature, such as high oil prices, or expected to be temporary in duration, such as supply shortfalls and higher transport costs. The committee agreed that, in the absence of any further significant economic shocks, more persistent consumer price inflation pressure is expected to build over time due to rising domestic capacity pressures and growing labour shortages. However, the committee noted that uncertainties remain as to the pace and magnitude of any pass-through of costs onto medium-term inflation, especially given reported underutilisation of labour, modest wages growth, and well-anchored inflation expectations. The committee noted that medium-term inflation and employment would likely remain below its remit objectives in the absence of some ongoing monetary support. However, the committee agreed that the level of monetary stimulus could now be reduced to minimise the risk of not meeting its mandate. They said, members reiterated their opinion that the OCR is the preferred tool when responding to economic conditions in the future. The committee agreed that some monetary stimulus remains necessary to best ensure CPI inflation will be sustained at the 2% per annum target midpoint, and that employment is at its maximum sustainable level. However, the committee also agreed that the level of monetary stimulus could now be reduced to minimise the risk of not meeting its mandate, which, remember, now must include consideration of the impact on home prices of their policies. And so now, ANZ, ASB and BNZ are now all forecasting the official cash rate will go up to 0.5% next month, following this announcement. The reduction in their quantitative easing program next week is almost a year earlier than was originally expected. Of course, QE is a mechanism to depress medium and longer term interest rates, which could now be expected to move higher. The bank's already bought $53.5 billion of central and local government bonds, and it flagged earlier that it might spend up to $100 billion on the program by June next year. ASB's chief economist Nick Tuffy said the Reserve Bank had clearly changed tack and could raise the OCR at any future meeting. Essentially, every OCR decision from now on should be considered live, he said. ANZ said the fact that the Reserve Bank had titled its release Monetary Stimulus Reduced was a big flashing sign that it considered the monetary policy cycle to have turned. And BNZ research head Stephen Toplis said it was to the Reserve Bank's credit that it had acknowledged the sheer pressure of the recent economic data and its inflationary risks. And Kiwi Bank chief economist Jared Kerr described the Reserve Bank's statement as hawkish, with the end of QE purchases ahead of market expectations. And Westpac's economist Michael Gordon said it still expected a rate rise in November, but said the odds of an August hike had risen. The New Zealand dollar jumped more than half a US cent. Explaining its decision, the Reserve Bank's Monetary Policy Committee said economic conditions since late last year had been persistently stronger than anticipated, and the risk of deflation and high unemployment had receded. The committee agreed that a least regrets policy now implied that the significant level of monetary support in place since mid-2020 could be reduced sooner so as to minimise the risk of not meeting its mandate, it said. And in fact, ASB announced earlier that it was increasing the interest rate on its 6-month fixed-term mortgage from 2.99% to 3.29%, and the rate on 5-year mortgages from 3.69% to 3.99%. The bank also announced interest on 6-month term deposits would rise from 0.8% to 1%, with the rate on 5-year term deposits rising from 1.75% to 2%. And Kiwi Bank also announced ahead of the Reserve Bank's meeting that it was increasing its 200-day term deposit rate to 1.2% from 0.8%. National Party Shadow Treasurer Andrew Bailey welcomed the Reserve Bank's decision to ease back on monetary stimulus, saying there was overwhelming evidence that the economy is heating up too much too quickly. And while a low OCR and QE might have been useful when there was a lot of uncertainty about the economic impact of COVID, they had helped fuel rising house prices and consumer inflation, he said. So this is yet another sign of a changing economic environment in New Zealand, and it's rather similar to some of the conversations that are going on, for example, Canada. And the question now is, of course, whether these interest rate rises will begin to spread. But I do think we can conclude that the lowest point in the interest rate cycle is past, unless, of course, the virus reasserts itself. And of course, this is going to put considerable pressure on many people with large mortgages and those potentially considering committing themselves to even larger mortgages ahead. Expect rate rises, expect the cost of mortgages to go higher, and that could put quite a lot of pressure on quite a few people. Now, of course, in Australia, Philip Lowe is still holding off until 2024. I wonder how long that will be sustainable. Well, probably not very long at all. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.